Well, good morning. Welcome to today's webinar, looking at China's growth potential after COVID. We're delighted to have with us Jean Ma, Head of China Research at the IIF in Singapore, and really looking forward to the session. Now, some of you will know me. I'm Mike Wardle, Chief Executive Officer at CEN, and deal with our index work, studying financial centres across the world and their development. My role today is to chair, so really to get out of the way very quickly and pass over to Jean to hear his keynote presentation. But first, I'd like just to say a brief thank you to our sponsors. We are very fortunate to have sponsors that allow us to range in this webinar series widely across the fields of economics, finance, science, technology, innovation, you name it, and we really are grateful for their continued support. Looking at the program for today, very briefly, it's me to introduce before Jean gives his keynote presentation. There'll be a Q&A session at the end of his presentation. For those of you who haven't used GoToWebinar before, the way to ask a question is to go to the dashboard on your screen, go to the questions tab and type in your question, and I'll field those questions at the end of the event, and we'll start a discussion going. Those of you who do put questions in, we will pass your contact details on to Jean afterwards, so if there's any need for any further follow-up, that can happen. And just a reminder that today's session is being recorded, so a recording of the session will be available on our website in about 48 hours' time. So if you find this presentation interesting and you want to share it with your friends and colleagues, that opportunity is available to you. So without any further introduction from me, it's time to pass over to Jean Ma, Head of China Research at IIF. We're really looking forward to his insights as he tracks what's happening in China very closely. And as we know, China continues to be one of the most important economies to be watching in the world. So, Jean, we're delighted to have you with us. Over to you.
Thank you, Mike. It is a quite extraordinary time for to talk about China because we're facing a lot of changes, shift in China's economy, its policy, even financial, economic leadership, and also China's relationship with the rest of the world. Let's start with the ending the zero COVID policy. It was abandoned basically in early December. Right after, in about 4 or 5 weeks' time, 1 billion people got infected, which is unbelievable. But very fortunately, we didn't find any new variant because when you have 1 billion people getting infected in 4 or 5 weeks, it's a very scary scenario situation. The fatality rate is certainly higher than the official number, but probably in line with this number we see in other Asian countries, also in Hong Kong. So in early January, Korea reported 70% of people arriving in South Korea tested positive, right, and dropped to 0. Okay, the point I want to make is that it is truly over. Even China's own CDC made an announcement, it's over. So, for example, travel between China mainland and Hong Kong right now are completely open. So we really can talk about economy policy in a post-COVID era. So next slide. So next slide, please. So we can go very briefly about economic outlook. So we expect about 5 to 5.5% growth in 2023. So the Premier in the report that they did before yesterday put out a target which is about 5%, which is pretty modest. There's a reason for it. Premier is going to retire in a couple of days' time. So when he gave out the target of the plan for 2023, he's really setting a target for his successor. So he is setting a very low bar, and it's pretty easy for successor to meet in 2023. I think the growth is somewhere higher than 5% this year. It's not a high number. Consider only 3% last year. You do the average, it's a little over 4% on a 2-year average term, which is still probably a little bit below potential. That is why you don't see much inflation in China right now. So that's what we see for this year. Next slide. So at this moment, what we see is that PMI bounced back very strongly. As you can see, the bounced back, in fact, also a little bit above consensus in February, especially for PMI service, which is the orange line in the left chart. It's way above the level we see in the late last year. Basically bounced back from 40 in last December to 55 right now. Now, what is really surprising is the PMI for trade, because we know trade basically collapsed in November, December. And if there are a lot of media coverage that containers are empty, containers are piling high in China's seaports. But however, somehow the PMI number showing that even the export-import orders also bounced back in February. So that's very strange. So we have to wait to see in March data to see really what happened. Probably the reason is that China export too much. Maybe the PMI number is telling the true story. Then the empty containers in the seaport. Reason is China export so much in the past 2 years. Now the empty container coming back to China. So in this case, the export will be much weaker this year, and maybe it's better than the empty container number tell us. Next slide. Yeah, so these are the trade numbers. So the export, if you see the if you look at the right chart, basically export to the EU to the United States collapsed in the late last year. And export to ASEAN are also coming down, but still growing at 10% in the first quarter. So it's very clearly right now. Well, we know in the past, China is the final assembly. China's buying things from Korea, Japan, putting together, shipped to the United States. This changed. Okay. Right now, China's shipping parts, components to ASEAN, put together and ship them to the United States to circumvent the trade tariff. So that's why China's export ASEAN goes in the same direction as they export to the United States, but not exactly in the same pace. Next slide. Next slide, please. So there's a bit the latency. So next slide. So beside the trade number, you can also see such a pattern from China's FDI. China's also increased FDI in ASEAN and also in Mexico to get closer to the US. Yeah, China's also helping the US due to the nearshoring. Okay. The reason we believe China can see a pretty decent recovery in its growth is basically its domestic consumption. Last year, I think China consumption was very low with the consumption growth. I think it was basically zero growth last year. We expect that it can recover to almost now net 9 to 10% this year. So if China's domestic household consumption can grow at a 9 or 10, given that house consumption about 37% of the GDP, that immediately give you a 3.5 to 4% point of GDP growth. And that is considering China's house consumption is a very small part of GDP compared with a much higher portion in more advanced economy. That can still give you a 3.5, 4% of GDP this year. Now, the reason we can expect a better consumption is that income will be better this year, consumer confidence should be a bit stronger, and the year-over-year base in the last year was very low, so that can get pushed up the year-over-year comparison. And more importantly, Chinese households are sitting on a huge amount of deposits. On the right side of the chart show you the new household deposits in 2022, that's 18 trillion RMB versus only 10 trillion the year before. Okay, and Chinese households took out much less in loans because they didn't buy as many homes as they used to in 2022. They put more money in the banks. On the right chart, the curve shows the stock of household deposit, not flow. The bar chart in the left is flow. The curve on the right chart is the stock. Basically, Chinese households are sitting on 120 trillion yuan of household deposits. Okay, that's a 20 trillion more than the number predicted using the trend before the COVID. So that's a lot of number. So 120 trillion yuan in banking deposits. That is about 80,000 RMB per person, about 200,000 yuan per family. Okay, even we say not all the money will be deployed, but still a lot of money can be spent in 2023. Okay, the problem is that most of the money will be spent on domestic service, domestic consumption, and the spillover to the global economy will be very little. We may see more China tourists in Thailand, Singapore, and that's it. So the spillover impact will be very different from the past. People remember in 2009, 2010, after the great financial crisis, when China pushed out a greater stimulus, and that created a huge commodity super cycle. This time can be very different because this time you can just see the China's work report just released yesterday. There isn't much stimulus this time, so we will not see a surge in China's infrastructure and housing investment. So that will not create much demand for global commodities. And for consumer spending, the money will be mainly domestic and mainly in service. So then it may benefit some sectors like luxury goods, but not that much more. Next slide. Yeah, another reason we see quite limited spillover is that we only expect China housing sectors to stabilize but not rebound in 2023. So the left chart shows you the home sales and housing start. In 2022, home sales, I think, is down about 30%. The blue bar is down by 30%. And the housing starts down about 40%. And moreover, if you can see the next slide, Chinese developers didn't buy much land last year. Yes, the left chart shows you the land purchased by developers. So that also basically collapsed by 50%. So when the land purchase down by 50% last year, and the housing started down by 40%, and you cannot just expect a sharp rebound in housing activity in 2023. So I think in 2023, housing activities in terms of home sales, housing start, construction activities, I think they are just less bad than in 2022. I think they stabilized from a very deep negative growth in 2023 to somewhere in zero or low single-digit growth in 2023. So again, we cannot expect a commodity super cycle from a housing activity. Next slide. Yeah, this chart shows you the developer finance and the local government revenue. We all know that land revenue is almost half of the local government revenue. And when the land sales down by 50%, and the local government is already highly leveraged, they just won't have the money to finance more infrastructure investment. And also, the problem with China's infrastructure investment, not only because of the finance, but also because it's already much overbuilt. You cannot continue to build bridges to nowhere. And the last year, the infrastructure investment was already growing at 9%, which is not too bad, because that's a part of a stimulus in a COVID time. So it's hard to imagine China can push the infrastructure investment growth even higher in 2023. So again, on the infrastructure side, we cannot expect much stronger commodity demand in 2023. Next slide. So if you look at the bar in the left, if the chart on the left shows you that the last year real estate was indeed very bad, but however, the investment growth for infrastructure and in the manufacturing sectors were growing at 10% last year. So the last year's growth was not too bad, thanks partly to the COVID stimulus, but they cannot grow much higher in 2023. Next slide. So another concern people have is that will China's reopening will be inflationary for the global economy? My answer is probably not. So during the COVID time, when China's economy was very weak, when China was experiencing deflation during lockdowns, China didn't help to dampen the global inflation, right? So why should we expect China will pushing up global inflation after it reopened? The China PPI, which is the left chart, used to have a very high correlation, which is highly correlated with the global PPI, but not for the CPI. The reason is that CPI has a large service component, which are domestic, which has very little pass-through or spillover effect. And also, given the fact that this time China's spending will be mostly on domestic consumption, on domestic service, with a very limited impact on commodities and energies. So I don't think a China's reopening will be that much inflationary for the global economy. On the oil side, China's buying the more Russian oil, which is boycotted by the Western countries. So again, I don't think that China's higher additional oil demand after reopening will push up much global oil price. Next slide. Another question is that what is the China's long-term growth potential? Because we saw China growth slow down from high single-digit pre-COVID to only 3 or 4% during COVID time. So some people have the view that China growth potential shift lower permanently. China cannot grow at that high speed anymore. So where is the China growth potential? So it's very hard to give a definitive answer. One evidence give you is China Phillips curve. That is when China's unemployment rate is below 5%. We do not see high inflation in China. Okay, so basically, if you look at China's Nauru, okay, now accelerating inflationary unemployment rate, it's around about 5. Right now, China's unemployment rate is about 5.5, with youth unemployment rate close to 20%, which is shocking, okay? Which never happened in China before. China right now has youth unemployment rate close to 18 to 20%. Something we saw in North Africa and Southern Europe during European debt crisis. So that is why we have the view that the China growth rate right now is still below potential. So 4% growth is below potential. Next slide. Yeah, this chart, I think I'll skip this chart. Basically, this chart, yeah, I skipped this monetary policy chart because this is something backward looking. In terms of the monetary policy, in a summary, that the PBOC will move from somewhat expansionary policy towards more neutral stance in 2023. Because the max inflation will move up from 2.1 last year to somewhere close to 3. Okay, so interest rate cuts and triple R cuts are off the table now. So that's why we'll see there's no stimulus in China in 2023. There are no stimulus on monetary side, and it's also very mild expansion fiscal policy on the fiscal side. Another key question people have is that, is China still investable? Okay, because people saw huge amount of capital outflow from China last year. So the left chart shows you that the foreign investors took out about $80 billion from China in terms of portfolio investment. I'm not talking about FDI or banking flow. We're talking about portfolio flows last year. That's the largest ever. Okay. Now, the problem is that last year, on the fixed income side, it was about 93 billion outflow. But on the equity side, it was 13 billion inflow in net. Well, if this outflow was triggered by geopolitical risk because of the war in Ukraine, China's close tie with Russia, and the risk over Taiwan Strait, then you should see the outflow in both fixed income and equity. Okay, the fact that outflow was only in fixed income, not in equity. In fact, you see some inflow in equity. That means the outflow was still triggered by Fed rate hike. And the reverse in China and the US yield curve, yield spread. And also, if you look at China's the equity flow, there's outflow in March when people were spooked by the Shanghai lockdown, and there was outflow in October during the Party Congress when China's policies was very uncertain. And otherwise, it was in net, there's a capital inflow for the whole year. Okay. And also, if people are really scared by the risk over Taiwan Strait, that people need to pull money out from both the mainland China and Taiwan, not just mainland, right? So it is still the policy uncertainty, the policy blunder last year, and the very poor economic performance and the Fed hike made people to move portfolio money out of China last year. And moreover, we see from a more granular observation, it is more the institution have a closer tie with the government. They tend to take money out. So see, Canadian pension funds, some sovereign wealth funds, they made an announcement that they're putting out the longer term non-liquid private equity deals from China. More liquid money are still stay invested. Okay. By the way, there was another report, I think yesterday, Mark Mobius complaining that he was not able to pull money out. So that was not portfolio money. That was meaning banking money, which is subject to KYC and AML. Next slide. So Premier Li Keqiang gave his farewell speech. In his 32-page speech, only 4 or 5 pages devoted to policy making 2023. So all about a summary of his achievement in the past 5 and 10 years. It's really not about the policy for 2023. So we'll see a new team coming into Beijing policy making theme. Next slide. So back in October last year, during Party Congress, people was very unsure who will take charge for China's economic policy going forward. Now we have a bit more clarity. So this is based on the speculation right now. So we will note the final announcement in a couple of days' time. So the most likely, the premiership will go to Li Qiang. The name is very similar. Mr. Li Qiang knew President Xi Jinping since the 1980s and 1990s. If you see the upright picture, it seems that they're very happy bear buddies. So Mr. Li Qiang, he was President Xi Jinping's chief of staff when Xi Jinping was a party chief back in Zhejiang. Mr. Li Qiang, this person, he is very much pro-business. He was very close to Jack Ma in financial. He met Elon Musk no fewer than 4 times. He can claim credit of getting Tesla to build the large factory in Shanghai. Next one. Well, even though he was hated for Shanghai lockdown, you have to know at the very beginning, he was very lenient. But then he suddenly switched gear, imposed a draconian lockdown in Shanghai when he received the order from the very top. The economic czarship was handed over from Mr. Liu He to Mr. He Lifeng, currently chair of NDRC. They are very different people. With Liu He, the world get to know him because he negotiated the first phase 1 trade deal with Donald Trump. Mr. Liu He, he was very bookish, Harvard educated, very nerdy, soft-spoken, very gentleman type. Ms. He Lifeng has a much more forceful personality. The current scoop is that in addition to being a vice premier taking charge of economic policy, he will also take the position of party chief at the PBOC. So he will not be the governor, but he will be the party chief at the PBOC. So that is the current speculation right now. Okay. Next one. Right now, one thing is not very certain is the PBOC governorship for the next 10 years. There's a chance Governor Yigang will stay because Yigang is well liked. He speaks good English. He's one of very few Chinese Beijing bureaucrats can communicate in English. But there's also a good chance that that goes to the gentleman called Mr. Zhu Lixing, who is the currently the head of Citic Group. Next one. So I will not go into all the details, but basically I want to see is that, okay, in a nutshell, I can give you 2 takeaways of the Beijing's economic and financial leadership. First of all, they're all very young. They're all in their 50s. No one in the 60s. They're all in their 50s. So it's a much younger cohort than the predecessors, than the cohort in the past 10 years. And the second, they're all very well educated. They all have very long experience in China's banking sector. So that's also a departure from their previous cohort. Because in the previous cohort, both Vice Premier Liu He and Governor Yi Gang, they were more academic type. They had no banking experience. So it's very different from the next cohort. So let me stop here and to save the rest of time for Q&A.
Well, thank you very much indeed, Gene, for that overview and some fascinating movements in the numbers which you've been tracking. Floor's open for questions. We have a few in already. First of all, from Douglas Andrews. He was taken by the consumer savings, the household savings figures that you gave, and just wondered whether you have any idea or expectation when those accumulated savings over the past 3 years will start to flow back into the Chinese economy in the form of spending on goods and services, housing. So, how quickly do you anticipate some of those reserves will start to be spent?
Yeah. Well, yeah, even though we know China's data quality is not that great, but the PBO's data is something you can trust, right? This is not too difficult. Okay, these are the data collected from banks. So 120 trillion in stock, 18 trillion flow. These numbers are real. The problem is that there's one caveat: is that it is possible not all those deposits are truly household deposits. Some of these can be business deposits by mom and pop shops, by proprietary small business. Okay, so these are, they take a personal loan, take a credit card loan to run small business. Okay, so some portion of the money can be business deposits, not household deposits. The reason you see such a surge in deposits because it bought a few homes last year. They also pull money back from stock market last year. See, also they pull money out of something called wealth management products. This is quasi shadow bank product. Okay, they put the money back into safer, more liquid bank deposits. Okay, so that's why not all the deposits can be spent right away. Okay, because a lot of things are just as a rebalance of household financial portfolio. Okay, so even though say 1/3, 1/4 of the money can be spent in 2023, still a lot of fuel for consumption.
Okay, thank you. Clive Bullen's interested about the relationship between the UK and China for trading and investment. How do you see it progressing, and do you think Brexit has made any difference to the trading relationship?
Wow, that's a difficult
Big
question. I think the Beijing's relationship with London is has a lot of up and downs. Okay, you have to remember when the Xi Jinping predecessor and even Jiang Zemin's time, they went to London. They really enjoyed the time they can ride in the carriage with the Queen. Okay, and I think that the time with Cameron was also pretty good. But it took a sharp downturn during Trump era and with Boris Johnson. I think Beijing is working very hard to find alternatives to the United States as a source of technology, as a trade partner, as basically someone they can talk to. Beijing have very few people they can talk to right now. It's a relationship with Moscow, in fact, is a lot more tricky than people realized. I have the view that Beijing was doped early last year to claim the friendship has no limit. And I also have the view that Beijing didn't know it was a war. The evidence of the Beijing diplomats told me that if they knew it was an invasion, they would evacuate Chinese students out of Kiev a lot sooner, a lot earlier. In fact, they were the very last to evacuate the Chinese leaving Kiev because they thought that was not a war, that was not an invasion. That's what Moscow told them. And also, you see the news lately that Washington's claimed that Beijing is considering sending weapons. The scoop comes from Moscow, not from Beijing. Yeah, maybe some companies send out some chips and the parts because not under embargo or sanction, right? And Beijing has been handling this relationship very carefully. At the same time, Beijing will complain, well, even we have so far behaved so well, we've done nothing more than the Indians and Turks do, but we never get any credit. Okay, we never get an appreciation from Washington. So go back to your question. First of all, if I can later on, I can give you one later. I can send you a chart later. Look at like where China is importing right now. China's import from Japan, United States, and EU has been declining consistently. Imports from Latin America is picking up. China right is importing more from Latin America than from Japan and the United States. It's getting closer to EU. So I think just in 2 years' time, Latin America will become a larger export to China, larger than Japan, larger than United States, larger than even EU. Okay. China relationship with UK, of course, very different. China will not buy commodities from UK, right? But China, I think, will be very keen, Beijing will be very keen to expand the financial ties with London. So see London as an RMB, offshore RMB center. China has been pushing for the stock connect between Shanghai and London for a while. There are a lot of technical difficulties, become time zone difference with the settlements. But you will see more Chinese companies go to London for listing. So for example, one of China's, I forgot which company lately, is this CAT-L, they are seeking listing in Switzerland rather than United States, because given the PCL will be in the auditing saga, it become a lot more difficult for Chinese companies seeking listing in NASDAQ and NYSE than seeking listings in London and Switzerland. So these are the things we should watch out.
Thank you very much. Akana Chantwala has asked to say a bit more about investors, referring to Mark Mobius commenting that he was unable to get his funds out of China, and really just to get a flavour from you of where you think the Chinese government is in terms of these kind of questions, and whether there's going to be an impact on investment in China. Basically, should investors be worried?
Yeah, that question, I was also very alarmed by this news report. So we don't know the full detail yet. As far as I know, my understanding is that that was not the portfolio managed by his firm. Rather, it was his personal money in the bank account. And then you have to, I think it's about 3 million banking deposits. And when you move the banking money out, you have to go through the AML and those paperwork. So that's why I think the banks, HSBC, right? The bank also came out and said, well, there's no change in terms of policy. This is the same old stuff. The paperwork have to do. Now, that doesn't mean there is no capital control. There is capital control indeed in China. Beijing pushed very hard in terms of financial opening in the past few years, but the financial opening was entirely about opening the financial market. Okay, there's a difference between opening the financial market and opening the financial account. They're different. Okay, the financial market right now is completely open. Okay, you can do asset management, brokerage, investment banking, insurance, payment, you name it. Okay, all type of financial service are open in China right now. Okay, Allianz get what's the latest one? Get the insurance license with 100% stake. American Express, Visa, PayPal got a payment license lately. But on the financial account side, they're still standing the wheel, right? Mostly those policies are against domestic residents rather than foreigners, because the policymaker knew very well, if you want to get foreign money in, then you cannot, you have to let them take money out, otherwise it will not come in the first place. So they knew it very well. So in fact, there is no new policy coming from Beijing, from SAFE, to limit the flow of foreign investors. Usually, they were so sent in the wheel for domestic residents. You have a quota for 50K a year. You want to withdraw cash, well, coming back next week. Okay, the guy who is in charge of this business is on vacation.
Thank you. A final question, really, my interest was piqued by some of the personnel changes that you talked about at the top of the economic institutions. Do you think the fact that, I mean, is this a proper generational change, sort of a new generation of leaders taking over, or is it simply natural turnover amongst the same group and the same people, the same thought patterns, taken forward from previous generations?
Yeah, so the party leadership transition happened in last October. She got his third term. Then he basically get a new group of the people in the political bureau, right? So, so the party transitions in the fall. Then the administration transition happens in the spring, basically right now. So they would restructure the whole administration. For example, they will restructure the Ministry of Science and Technology, which is a big deal. They will set up a new institution. They will set up a Bureau of Data, which is entirely new, which is a big deal. They also will shake up the whole financial leadership. Basically, they will streamline the whole financial leadership. Basically, they will elevate the status of the previously called CBIRC, China Banking Insurance Regulatory Commission. So we elevated the one into so-called Bureau of Financial Supervision, let it take out more functions, such as the consumer protection and the supervision of financial conglomerates. There are certain couple of large conglomerates is very difficult to deal with, like a Citic Group, Merchant Group, Everbright Group, right? They own banks, China Everbright Group, right? They own bank, they own Everbright Bank, they own Everbright Securities, they have asset management arm. So that's why in the past, they are supervised by different entities, by several entities. Now they have to consolidate into one entity. There's a Bureau of Financial Supervision. And in the past, China's bond market is also supervised by two entities. Now they're combined into one. They also streamlined the function of PBOC. A lot of details we probably won't be able to cover today.
Yeah.
And also, they will also consolidate basically they also changed the supervision at the local level. For example, the financial bureau in Shanghai, financial bureau in Beijing, in future will be staffed and supervised not by the local municipal government, but rather than by Beijing. Basically, in a nutshell, they'll be streamlined and the power will be consolidated at the very top.
Okay. Well, thank you very much, Jim. We have run out of time, I'm afraid. A fascinating session, and many my thanks to you for that. My thanks also to our sponsors again, just for enabling us to run these webinar sessions. And looking forward on the future agenda, we have other events coming up which you may be interested in. Tomorrow, looking at agroforestry systems. Next Monday, creative consulting. How to move from misdirected efforts to transformative results. A session next Tuesday focusing on Mauritius as a financial centre and the role of the central bank digital currencies next Wednesday. Do keep an eye on our forthcoming agenda, and we look forward to seeing you again. But before we leave, just finally to say a huge thank you to you all for attending, but particularly to Jean Ma for taking the time to put together a fascinating insight into a time of change in China's economic management. Jean, normally I'd throw the floor open for a round of applause. You'll have to have a very small round of applause from me today. But many thanks indeed for your time. It's been fascinating. Thank you.
Yeah, pleasure's mine. Thank you.
Thank you.